Did everybody get the answer?
I think three still.
Okay, we'll revisit 7. So these last 4 exercises were all related to each other. Is that right? Yes. So we had calculated the transfer pricing here from Department A to Department B. Instead of redoing that, we can just go back and look at it here. And what we saw was that Department B lost money. And we converted that to a percentage by taking the amount of their loss and dividing it by sales, right? That's how we do this sort of vertical analysis. You divide everything by sales. So what does this minus 8% tell us?
Was it divided by sales that we got?
Mm-hmm,
Yeah.
mm-hmm.
Then an 8% loss in, or is it, I guess, yeah, the 3,920 loss is 8%. Is it less than sales?
It's equal to 8% of the sales.
Okay.
Yeah, so you were almost there. You were so close. So that loss was equal to 8% of their sales, which really suggests that out of $51,000 of sales, none of that became profit, right? It all got eaten up by costs. And then an amount equaling 8% of those sales was actually how much money the company lost. So obviously, that's not great for Department B, right? You don't want to be losing money. If you remember, everything Department A sells, it sells to Department B. So this $22,000 of sales is a big part of Department B's costs. And we looked at why the cost is so much for what they buy from Department A. And we saw, well, high wages could be part of it. We also noticed that, remember, these costs allocated from corporate have a significant impact on Department B, right? So, okay, so then we already did 6. So now 7 says, based on our research, we determined that the market price for what we buy from Department A is 15% below. So in other words, what's available out in the market is 15% less than what we're paying Department A. Again, that wouldn't be fair, right? I think we did answer these questions, didn't we? How would we view this as a manager? I would say unfair. What steps could we take? Either, well, we could renegotiate with Department A. And if we have control on where we purchased, maybe purchase from an outside supplier. Right? So now we can go on to 8 and say, if Department A did reduce the price to the market rate, how would that impact operating income for Department B? In other words, if Department A dropped their price by 15%, what would be the impact on Department B? Well, that's pretty easy to address. Again, $22,000 is what we bought from Department A, right? I could just say minus 15. No, actually, no. I take that back. Do it like this. $22,000 times 15%. If they drop their price 15%, that saves us $3,300. And since we lost 3,920, if our costs reduced by 3,300, that's $3,300 we didn't lose, right? So what would be the amount of our loss in that case? 620. Right, so before we were losing 3,920, but we're going to reduce that by 3,300. Like Ivan said, now we only lost $620. There are other ways you can calculate that, but that's the easiest way. Sorry, I keep going to the wrong document here. So for 8, the current operating income is negative 3,920. If we get that 15% reduction in the price from Department A, that loss would then only be $620. They told us here how many units were produced, but we didn't really even need to know units. We could just take the total sales, multiply by 15%, because that's what we're buying from Department A. And we saw that 15% saved us $3,300. Any questions? All right, well, let's move on to our problem set then. We are going to go through all 8 problems. This is one of those chapters where the problems are different enough that it might not be clear how to solve some of them. So we'll go through them together. All right. I opened the wrong problem set. That was chapter 8. Let's try chapter 9. 8, yes, okay, there we go. Y'all were probably wondering as well. Okay, remember the 3 golf courses we saw in the exercise set? Well, they're back. And we're going to do, in this case, a vertical analysis. We didn't do that last time. We did fill in these missing numbers. This was 11,000. Over here, we took total expenses minus the other expenses. This was 56,300. And then how did we get operating income over here? Okay, total revenue minus the total expenses gave us 23,770. Okay. And so that's what we did in the exercise set. We did a little bit of an analysis. But now we're going to convert it into percentages. We're going to do a vertical analysis. So again, when you do that, you divide by your sales or your revenue. And it turns everything into a percentage, and then it's easier to see the relationships of the numbers. So starting with an operating income percentage for course A, we divide it by our total revenue for course A. And that's 15.37. I don't remember how we are rounding here, so I better check. Okay, to the nearest percentage, so 15%. And then for each of these costs, again, we're just going to take the amount divided by total revenue. That also the nearest percentage? Actually, that would be 11, wouldn't it? Oh, 10, oh, we're doing one place after the decimal point. Okay. I wish they would just be consistent, be easier. Okay, let's just keep, I'm going to go through these quickly. It's just a matter of doing the calculations. Let me know if I get anything wrong here. How's it looking so far? Got the bottom. Okay, one more to go. Okay. Anything there that doesn't look right to you? Okay, I think that's right. So now we've done our vertical analysis. Again, don't really worry if some of the cells change colors. Might tip you off that there's something interesting there, but don't read too much into it. So now that we've done that, again, it gives us a different way to take a look at what's going on here. Alan, make sure you put your name on the list there. All right. Oh, it's up here. Daniel. Had it. Okay. All right. Which company had the best operating income percentage? Or which course? C, right? You can see as a percentage, it's 34%. So that means of what they sold, 34% of it is profit, which is a lot better than 15 and 17% over here. Now, Core C had the lowest sales, but they did the best job of turning those sales into profits. How did they do that? Okay. Yeah, exactly. Their wages were only 46% of their sales compared to the other two courses, which were much higher. Landscaping was a lot lower. Fuel costs were lower as a percentage. Utilities were even lower, right? So they did a better job of managing their costs, at least from what we can see. You know, I mean, maybe they're cheating or maybe they're cutting corners or something. We don't really know the full details, but just from the numbers, it looks like they're doing a better job managing costs. And it's easier to see that with these percentages than it would be trying to just compare all these dollar amounts, right? Okay, so based on our analysis, what accounts would we want to investigate? Actually, did we comment on how our analysis has changed for each course? Okay. Well, as Ivan said, we can see that course C is doing a better job, or at least it has lower costs as a percentage. That's something that wasn't as easy to see previously when we only have the dollar amounts. So I'll just go ahead and write that here. Course C seems to be doing a better job of managing its costs.
Those the course 8.
What's that?
It was course 8, the one that was managing.
Well, see, course C's costs are a lower percentage of sales, right? Like wages here, 59% for both of these courses and only 46 for C. So okay, so then based on our analysis, what accounts would we want to investigate further? Well, there's a pretty big difference here with landscaping, definitely with wages. With repairs and maintenance, actually course C is a lot higher than course B, so not sure that that's really worth investigating. Also, it's kind of a low dollar amount, so wouldn't hurt, but it's probably not top priority. And here the costs are kind of in line with one another. They're not that different from course to course. But I would say definitely we'd want to look into why the landscaping costs and the wage costs are so much lower for course C. And how might we use this information? So once we look into why course C has such lower costs in these two areas, once we have the answer to how they're achieving that, what would we then do with that information? Okay, we could share it with course A and course B and say, hey, look at the best practices that course C is doing. If you can do this as well, maybe you can bring your costs down. That is definitely a possibility. On the other hand, is it possible that we investigate and again, we find course C is cutting corners or cheating, right? And then we want to take a different action. So I would say, share the word I'm looking for. Was that? Yeah, well, best practices is more what I'm looking for. Share the best practices between the courses. Because that could go either way. Again, if it turns out course C is not doing things properly, then we're gonna make sure they're doing things the way course A and B do it. On the other hand, if course C is doing something better, we'll share that with A and B. But either way, we're sharing best practices across the courses. So which method of analysis, using just the dollar values or using just the percentages, is the most relevant and or useful? You could use one or the other. Which would you prefer, looking at the dollar values or looking at the percentages?
Percentages.
I think it is easier to use, right? Because you could just compare one to the other. Whereas if you got the dollar amounts, they all have different revenues and different costs. And how do you really see the relationships there? On the other hand, there is value to looking at the dollar amount as well, right? It's good to know that course B has $95,000 in revenue. And that course C has only 78,800 in revenue. That's important as well. So which method of analysis? I would say a combination of both is ideal. Although the percentages make it easier to compare the courses. Any questions on this exercise? I mean, problem? Okay. Number 2 has a lot of number crunching. And again, we are going to go through it together because it also requires some analysis, and we can't really do the analysis until we've crunched all the numbers. Now, number 2 is based on actual data from Netflix from 2015 to 2017. And you've probably heard of Netflix, right? Some of the data is not actual. The assets, as it says here, the assets are fictitious because they didn't actually have that information, so they just made up the assets, but everything else is actual. And I think, God bless you, yeah, it says here, all numbers are in thousands. So when it says, for example, Netflix domestic streaming revenue in 2017 was 6 million, it's actually 6 billion. So you just have to multiply everything by 1,000 if you want to know the amount. All right, well, what we're going to do is 3 types of analysis. Let's see, we're first going to do a contribution profit percentage. So we're just going to take the profit in each division for each year, divide it by the revenues, and turn it into a percentage, kind of like the operating income percentage we did in the last exercise. So we'll do that for all 3 years and all 3 divisions, and then we'll analyze the data. Then we're going to do ROI, again, all 3 years, all 3 divisions. And then we're going to do residual income for all 3 years and all 3 divisions, okay? So I'm just gonna go through this as quickly as I can as far as the number crunching, and then we'll stop and we'll analyze each one. Again, if you see me miscalculate anywhere, let me know. Oh, and let me see the rounding again. Okay, 1 place past the decimal point. Again, we're taking the profit for each division for each year, dividing it by the revenues. And when we get to international streaming for 2015, notice it's a loss. You have to enter it as a negative number. So there was a 9.6% loss. Then you again have to clear out your calculator before you enter a negative number, otherwise it's going to give you an invalid result. Okay, any questions about what we're doing here? Okay. Let's confirm. And that looks right to me. Okay. So now that we've done that, again, it's easier to analyze because we could just look at the domestic streaming starting from the 2015 going all the way to the 2017 data. And we see continuous increase, right? In the contribution profit percentage. How about with international streaming? How are they doing in that division? Well, yeah, except in 2017, now they're making a profit, right? So they went from losing 17% to only losing about 10% to now actually having a 4% profit. So that's a good trend, right? That's a pretty significant improvement. And we see improvement here as well. So they had growth in all three areas, according to this analysis. Okay. If we had only looked at the dollar amounts, yeah, we see growth here. Oh, actually, I'm sorry. If we looked only at the profits, okay, we see growth. We see growth. Oh, here actually, their profits are going down. That's interesting. The profits are going down, but their profit as a percentage of revenues is going up. How do we explain that?
Moving away from DVDs, so we don't have any more costs.
Well, yeah, it does have to do with the costs, right? Their costs are going down their costs are going down faster than their revenues are going down. Even though their revenues are going down, for some reason their costs are going down faster. Okay. So the percentages allow us to see that the domestic DVD division is increasing its contribution profit percentage despite the fact that its profits are declining. Any questions or comments? Okay, so for part B, we are going to do a return on investment analysis. So the assets that are given to us here is the investment for each division and each year. So those are assets that are being invested into the division. So what we need to do is take the return, which is the profit from part A, divide it by the assets from part B. So let's see, what's going to be the best way to do this here? What I'm going to do. So this is just temporary, so you don't need to do what I'm doing. Just going to save us from having to scroll. And, okay, so I got the profits for all three divisions. So we're going to replace these numbers with the ROI after we do each calculation. And again, let's see if we're using the same rounding here. Yes. Okay. So what we're going to do is I'm going to take the return, divide it by the investment, and then whatever that percentage is, I'm going to put in the place where the return was. Okay, just to save us a little time. Here I got 15.2%. $13.1. $13.8. $3.8. And then here we have a loss. So negative 308,521 divided by the assets that were invested. And we get negative 7.7. And then we've got another loss. Negative 16.7. Okay, 16.5. What would that be? 14%? And the last one, 10.8. Okay, let's check those numbers. So, wait, doesn't look right. Oh, good. Okay. Oh, we're rounding off to the closest percentage. Okay. 15, 13, 14. Sorry about that. I guess I looked at the wrong one. I mean, you could, yeah, you might as well make it consistent. So let's see. 4, negative 8, negative 17. 8, 17. And then 17, 14, 11. 17, 14, 11. Okay. There we go. So let's take a look at these ROIs for these. It's the same 3 divisions, same 3 years. How did the domestic streaming division do over those 3 years? It's like they slipped a little bit in 2016 and then bounced back in 2017, right? International streaming, again, they went from a negative ROI, just like they had negative profits, to positive. And domestic DVD continued to improve. So we could say domestic streaming, I'll say stayed fairly stable, while the other divisions improved ROI significantly. So any questions? All right, so we've done now B. Let's move on to C. For C, we're doing residual analysis. So again, or residual income analysis. We need to know the assets times the cost of capital, or times the cost of capital percentage, I should say. So these were the assets here. They tell us the cost of capital percentage is 7. So we can take the assets times 7%, and we'll plug those numbers in here. And okay. Here we have the cost of capital. What's the next step? How do we actually calculate residual income? Remember? We need to take the income or profit and then subtract the cost of capital. So I'm going to go ahead and do like I did before. I copy these numbers down, and then I'm going to go ahead and replace them with the calculations. This is one of those cases where a spreadsheet could save us a lot of time, but a little late now. Okay, so I'm going to take each of these profits or losses, subtract cost of capital that we calculated, and that will be our residual income. Make sense? I think I hit the wrong button there. Okay, one row down. And now this is interesting. So international streaming had a negative residual income, or had a residual loss in 2017. I guess I ought to be consistent here with the negative numbers. Okay, hopefully I did this right. Anybody catch any typos?
Isn't it, aren't you supposed to subtract it and then multiply it by the 7% cost of capital?
No, because this was already the assets times the 7% cost of capital,
So
and
it's
then we
already done.
subtracted that from the profit or loss to get the residual income. Yeah. Okay, well, let's make sure these look right. So that's good. Okay, I think that's all correct. So we've done our residual income calculations. And like I mentioned, we see now that even though the other two analyses showed us that we had a profit for international streaming for 2017 and we had a positive ROI, we have a negative residual income. In other words, when we factor in the cost of capital, you see actually this international streaming is not doing that well. Anything else you notice from this analysis here? Do you remember how domestic streaming, when we looked at the ROI, was just staying fairly stable? But when we look at residual income, it's growing. So I'll say this analysis shows us that domestic streaming, so that's, yeah, streaming residual income is growing, and international streaming still has a negative residual income. Be interesting to see the last couple of years with Netflix. And I know during the pandemic, they were doing very well. And I think it's slowed down a little bit since then. So again, it was a lot of number crunching, but hopefully you see how these different approaches give us different perspectives. And companies typically do use a variety of tools when they do financial analysis. Look at a variety of ratios and try to get a complete picture of what's going on. All right, are we ready for number 3? Jack.
That 7% cost of capital is how much interest they expect to pay on borrowed capital over time, or how much improved performance they expect.
Yep. Zay, did you have a question as well?
I was gonna say, in actual like practice, would they just do this in a spreadsheet just for the ease of it?
Yeah, or they might have software that just calculates it all for them and gives them the results. Actually, now with artificial intelligence, they could even analyze the results for you. And it's pretty incredible what can be done with artificial intelligence. So yeah, large companies, I'm sure, have very robust reporting software. Okay, so let's move on to number 3.
I believe we did number 3 on Tuesday.
Oh, did we?
Yeah.
Oh, yeah, we did. Okay. All right. Well, for anybody watching this video then, I'll let them peek at the answers in case they weren't here. So they could always pause the video. And we can go on to number 4. Great, thanks for pointing that out. Oh, okay, so number 4, this is one of those where the assignment says you're supposed to use a spreadsheet program and you're supposed to make all these charts, but I know not everybody here is familiar with spreadsheets. It is a good idea to learn spreadsheets. We will be using them a little bit in this course, but you're not going to have to make these charts, so they're already there for you. But we are going to read through what's going on here and try to use our analytical skills to figure out from these charts what we think is the underlying issue. So we manage a football factory, and the leather department is a cost center. We're reviewing the scrap costs, and this is what we see. Again, it's just a whole bunch of data points, so it's kind of hard to really analyze, but we can see that basically we reached our highest scrap costs here in the summertime, right? That's fairly clear. And we ask the maintenance manager for some information about, well, they give us indoor temperatures for each month, air conditioning spare parts, and number of air conditioning breakdowns. Now we have all this data. Looking at just the raw data, it's a little hard to really see what's going on, but if we look at the charts, we see clearly summer months are when we have the most leather scrap from making our footballs. Oh, we're supposed to describe our observations. Okay. Is that where I'm supposed to put it? Yeah, I'll just type it right there. So our observation is the highest scrap period is the summer. Okay. And then we will move on and look at the other charts here. So this shows the temperature of our facility. We see it gets hottest in the summer. It kind of makes sense, right? Peaks here in August. Our scrap was peaking in September, but maybe there's a correlation here. This is spare parts for the air conditioning system. So we start off the year with a fair amount of spare parts, but that inventory dwindles and reaches its lowest point here also in the summer months. Right? It stays pretty stable here after that. And we see air conditioning work orders. None in January and February. They increase as the temperature gets warmer, peak again in August, and then they go down again. So based on these charts, what do you think is causing our scrap materials to be so high in the summer?
Orders are heavy.
The work orders for the air conditioning? Okay. Yeah, I mean, you can see some correlation here. Perhaps as it's getting hotter, we're running the air conditioner more, it's breaking down. They're having to use parts to fix it, but those parts, you know, are getting used up. So there seems to be a correlation with the heat and the scrap materials. Maybe it's time to get a new air conditioner. I don't know. So for B, again, describe our observations. We could say something like there appears to be a correlation between the heat, the air conditioning, maintenance, and shouldn't say maintenance issues, the air conditioning maintenance issues, and the scrap leather. We might have been able to see that looking at just the raw data, but when you've got charts like this, it just makes it that much easier to see. And that's all we have to do on that problem. So we can go to 5. Okay. And we're going to make an income statement. As part of the process, we're going to do we're going to figure out our profit margin percentage, our ROI, and our residual income as well. Okay, so we start with sales. We look up here, sales is $189,000. Cost of goods sold, $119,070. How do we get gross profit? Exactly, we subtract 69,930. And we plug in our expenses. We've got labor at 41,580. Depreciation, 17,000. Selling is 1,250. Administrative, 690. Other is 320. Then we have some uncontrollable costs. Allocated is 2,035. We have R&D and we have marketing. R&D is 315, marketing is 790. Okay, then we can add up all of our expenses here from labor expense on down to get a total. I got 63,980. That sound right? Check it. Yep, 63,980. Okay. And then how do we get pre-tax income? Exactly. So gross profit minus total expenses, we get 5,950. Then if we have a 21% tax bracket, multiply by 21%, we get 1,249.50. I think they round that off. Yeah, they do, because our answer, our net income comes out to $4,700. Okay, that's pretty easy, right? So then our profit margin percentage, we take our net income and we divide, what do you think we divide by? Our sales? (2.5%). 2.5%. Okay, if we had to invest $100,000 to make this 4,700, how do we figure out our ROI? The net income is the return, right? 100,000 is the investment. You take the return divided by the investment, and we get 4.7%. Now, if we have a 6% cost of capital and our investment was $100,000, we multiply $100,000 investment times the 6% cost of capital, and we get $6,000. Now, to get residual income, what do we do? Exactly, we subtract it from the net income. So 4,700 minus 6,000, we have a negative 1,300. And it says, prepare a short response to accompany the income statement that explains why uncontrollable costs are included in the income statement. So if you remember, there were 3 uncontrollable costs here, right? R&D, marketing, and then some allocated costs that we don't really know what they are. But whoever's in charge of this organization does not have control over those costs. They're being allocated by some parent company or something. So why are we even including them in this income statement? And you could argue that we shouldn't, but if we are going to include it, the argument would be that even though they're being, well, even though they're not controlled by BDS Enterprises, the organization receives some sort of benefit from these costs. So we go ahead and include those allocated costs to have a better picture of how much they're actually providing in value. So we could say BDS, which is the name of the organization, receives some sort of benefit from these costs. So they are included to provide a clearer picture of the organization's performance. Again, you can dispute that perspective, but that's not what we were asked to do. We were asked to explain why they're included. Any questions? Okay, with problem 6, we're actually going to use the same data. This time we're going to separate out the uncontrollable costs and see what it all looks like. So a lot of this we can copy and paste. Sales, cost of goods sold, and profit are going to be exactly the same. So I'll copy those down. Next section, we've got labor down to administrative expense. So all of the controllable costs. Got labor down to other, it looks like. Okay, so now we need a total of those costs, which again does not include the uncontrollable costs. Okay. And so now to get our operating income, we're going to get a different result, right? Take our gross profit, subtract the controllable costs, get 9,090, which is A lot better than 5,950. Then we're going to go ahead and put those uncontrollable costs down here. So those were allocated R&D and marketing. We will total those up. But we're still reporting them. We're just separating them so it's clear which costs we have control over and which we don't. And then now we're going to do our analyses here based on the calculations that don't include those uncontrollable costs. Okay, so operating income, I guess we still do have to figure out pre-tax income, which comes out the same, which means last part's going to be the same as well. But down here, our operating income margin, now instead of using the 4,700, we're using the 9,090, which does not include those uncontrollable costs. And again, we're dividing by sales. So 9,090 divided by sales. Now we have a 4.8% operating income margin, which is a lot better than the 2.5 we had previously. For ROI, we're also going to base it on our operating income here. Divide it by our $100,000 investment. Call that 9.1%. And for residual income, we'll take 9,090 operating income minus the $6,000 cost of capital and get 3,090. So again, if we take out those uncontrollable costs, our analysis looks a lot better, right? And that's it for number 6. Any questions? Okay. So let's go on to 7. 7 has 3 parts. This is a transfer pricing situation. And we have a transportation department transferring to a bottling department. There are 3 potential prices. A cost-based price, which, as you probably recall, is based on just the variable costs. There's a market-based price, which is the highest option, and then a negotiated price in the middle. So we're just going to calculate income statements using all 3 scenarios and based on 278,000 gallons of material transferring from the transportation to the bottling departments. So we'll start with cost-based at 62 cents, 278,000 gallons. So that's $172,360, which is the entire sales for the transportation department, because everything they sell to the bottling department. And everything the bottling department buys, it buys from transportation. So that same number is the cost of goods sold for bottling. And now we can fill in the rest. So for transportation, gross profit, 82,733. And we can subtract their expenses. Get 7,407. And then how do we turn that into an operating income percentage? Divided by the sales. So 4.3%. Actually, let's check the rounding on this again. Okay. We'll call it 4%. And we'll do the same thing over here. Sales minus cost of goods sold gives us gross profit 40 minus expenses 38,240. Divide that by sales. And that's 13%. Okay, so in this first scenario, transportation has a 4% operating income and bottling has 13%. Right? Then next we're going to do the market-based price, which was 74 cents per gallon times the 278,000 gallons. So 205,720. Subtract cost of goods sold. Subtract the expenses. Divide by sales. And that's 20%. Again, sales for transportation is cost of goods sold for bottling. We get a gross profit of 80,000. Was that 280? Subtract expenses, 4,880. And that is 2%. Okay. Well, in the market-based scenario, transportation's doing great. Bottling, not so great. Then the negotiated price is 70 cents. And again, it's based on 278,000 gallons. So 194,600. So it looks like 15% operating income for transportation. And looks like 6% for bottling. Okay, that was a lot of number crunching there. So in the first scenario, we have 4% versus 13%. Second scenario, we have 20 versus 2. And the third one, 15 versus 6. Okay. So prepare a brief summary of the results. So which of these three approaches seems most fair? And we had 4 versus 13% here. That was based on cost pricing. Market price gave us 20 versus 2. And a negotiated price gave us 15 versus 6. Seems like the negotiated price in the middle seems to be the fairest distribution. And so that's what we can say. The negotiated price provides the most fair distribution between the two. Any questions? All right, well, we got one problem left. This is from Coca-Cola. This is actual data from 2017. And what we're supposed to do on this one, we've got 1, 2, 3, 4 different regions, plus whatever bottle investments is. And we have 2 different years. And what we're supposed to do for each year is look at their inter-segment sales, which is how much they're selling to other Coca-Cola segments, and figure out what percentage of that is that of their total sales. So for example, for Europe, Middle East, and Africa for 2017, we would take 42, it's millions, but we can just leave off the millions because the percentage comes out the same. 42 intersegment sales divided by the total sales, and that would be 0.6%. And we would do that for each of these regions for each year. I'm not going to make us go through it because if we look at this chart, the answers are right there. I usually do make us go through it, but I'm not going to do that today. So if we look at the chart, again, it's a lot easier to see what's going on. Orange is 2016, blue is 2017. So in that same Europe, Middle East, Africa region, we see their inter-segment sales within Coca-Cola decreased from 3.6% in 2016 to only 0.6% in 2017. We see a slight decrease in Latin America, a huge decrease in North America, slight decrease in Asia, and really the only place where inter-segment sales increased as a percentage of total sales was bottle investments. Again, whatever that is, I don't even know. So, comment on our observations of the data. So we can say inter-segment sales are declining in all segments except bottle investments. And the last question, how might a division sales manager use the data? So if you see these kind of trends, you're the sales manager, are you going to be encouraging more inter-segment sales? Or are you going to say, inter-segment sales appear to be over, let's focus on external sales? I think it'd be more the latter, right? Whatever this trend is, that's pretty significant. I guess we really don't know. Maybe there's an opportunity, but it looks like there's more opportunity for external sales. Okay?
So that would be dependent on which segment you are, right? Like if you were in Latin America, obviously your segment's not that much, but if you're in North America, it's a huge portion.
That's true. That's true. It does kind of depend on where you are, because some regions are not experiencing as much of a change. But overall, if we look at just the total impact globally, It looks like the company's moving away from these intersegment sales for whatever reason. So if my job is to get my team to sell as much as possible, I'd probably say focus more on the external. So have team focus on external sales. Since intersegment is declining generally. Okay. And you might want to just fill in the numbers or at least know where to find them on that chart in case any questions come up on the problem set based on any of those percentages. Again, they're right here in the chart, right? The percentages are right there. So that is it. Good luck, everybody. Have a good weekend. I'll see you on Tuesday. We're right on time.